Hi again, I'm Kora, and welcome back to Tokenization 101. In our last episode, we explored the role of blockchain in tokenization, the foundation that makes everything secure, traceable, and programmable. Today we're talking about something just as critical, but often misunderstood: custodianship. Now I know, the word custodian might sound old school, even a little boring. But in the world of real-world asset tokenization, custodians are one of the most important players in the game. They're the ones who hold, verify, and often protect the real-world assets backing digital tokens, making sure everything is real, accounted for, and secure. So let's unpack this. What exactly is a custodian? Why are they essential to RWA tokenization? And how do you choose the right one for your project? Let's dive in. Let's start with the basics. At its core, a custodian is a trusted third party that holds assets on behalf of someone else, usually to ensure safekeeping, reduce risk, and improve transparency. In traditional finance, custodians are often banks or regulated firms that hold your stocks, bonds, or money in a secure account. They don't own the assets, they just keep them safe and track everything. Now, in the world of tokenization, custodians do something very similar, but with a mix of physical assets and digital infrastructure. Let's say you want to tokenize 100 kilograms of gold. That gold has to go somewhere: a vault, a refinery, a secure storage facility. The custodian's job is to confirm that the gold exists, safeguard it from theft or tampering, document and audit the gold regularly, provide proof to the token issuer and sometimes regulators. Without a reliable custodian, your gold-backed token is just a promise, but with a custodian, it becomes verifiable, real, trustworthy. Now, not all custodians are the same. In RWA tokenization, we typically deal with two major types. 1. Physical asset custodians. These are entities that hold the actual tangible asset, like vaults for gold and precious metals, warehouses for agricultural goods, land registries for real estate deeds, banks or regulated institutions for fiat reserves. Their role is physical, concrete. They're about proof of existence and storage. 2. Digital asset custodians. These are firms that specialize in holding digital tokens, private keys, or cryptographic assets in secure wallets, often using multi-signature setups, cold storage, or advanced cybersecurity tools. These custodians are especially useful when you're managing investor wallets, you're handling regulatory compliant lockups or transfers, you want institutional-grade protection, and in many tokenization projects, you'll actually need both types working together. One to hold the real-world asset, one to handle the digital side. It's like having a vault on one end and a firewall on the other. Now you might be wondering, can I just hold the asset myself? Technically, maybe, but practically, it's a huge risk. Here's why custodians are so important in tokenized ecosystems. Trust anchor. Investors need confidence that the underlying asset is real, safe, and verifiable. A reputable custodian provides that confidence. Regulatory compliance. Many jurisdictions require regulated custodians to be involved when financial instruments are tokenized, especially if the token represents ownership, profit rights, or deposits. Risk management custodians reduce fraud, theft, and operational risk by separating duties. The issuer doesn't hold the asset, the custodian does. Audit and reporting. Third-party custodians provide audit reports, inventory certificates, and independent documentation. This helps you remain transparent to investors, partners, and regulators. Institutional access. If you want banks, funds, or family offices to invest, they'll likely ask, who's the custodian? It's part of the trust stack, so even though they work in the background, custodians are a cornerstone of credibility in RWA tokenization. Okay, so let's say you're launching your own tokenized project. How do you pick the right custodian? Here's what to look for. Licensing and regulation. Is the custodian regulated by a national authority? Look for licensing under financial regulators like the SEC, FSCA, FCA, or equivalent. Auditability. Can they provide regular reports, certificates, or real-time asset tracking? Transparency is non-negotiable. Experience in the asset class. If you're tokenizing diamonds, Your custodian should have industry expertise, not just a generic vault. Jurisdiction. Where is the asset being held? Some countries offer better legal protections or tax benefits than others. Service-level agreements, SLAs, define who is responsible for what, including custody fees, dispute resolution, insurance, and compliance obligations. Integration with blockchain. Can the custodian interface with your smart contracts or token logic? Oracles and APIs help bridge the gap between off-chain and on-chain systems. Choosing a custodian is like choosing a business partner. It affects your credibility, your investor trust, and even your legal standing. Let's make this more real. Example 1. Tokenizing gold in South Africa. You partner with a registered vault in Johannesburg, regulated under South Africa's Precious Metals Act. They store 500 kilos of LBMA-approved gold. Every month, the vault issues a digital certificate and uploads it to a blockchain oracle, updating token supply accordingly. Investors can trust that their gold-backed token is tied to audited metal in a government-recognized vault. Example 2. Revenue-sharing token in the U.S. You tokenize revenue from a rental property in Miami. You work with a legal custodian who holds the real estate deed, manages bank inflows, disburses token-based returns to holders. The digital custodian ensures that tokens are held in compliant wallets, with KYC/AML controls applied. Here, custodians are involved on every level: legal, financial, and technical. Now let's talk about something else: non-custodial models. Not every token project wants, or needs, a centralized custodian. With non-custodial wallets, users hold their own tokens and private keys. There's no third-party controlling access. In many ecosystems, especially DeFi or community-based DAOs, this model works well, as long as the underlying asset is digital, not physical. The project is utility-based, not a regulated security. There are no legal custody requirements. However, when you're dealing with real-world assets, especially things like land, gold, or bonds, some form of physical custody is often mandatory. So think of it this way: non-custodial, great for user empowerment and self-sovereignty. Custodial, necessary for real-world verification, legal clarity, and institutional-grade compliance. Let's recap. Custodians are the bridge between the physical and digital worlds. They hold your gold, your property deed, your carbon credits, and make sure your token is backed by something real. Without them, tokenization would be built on trustless claims. With them, we create verifiable value, backed by contracts, audits, and physical controls. So whether you're an issuer, an investor, or just learning the ropes, remember, behind every credible tokenized project is a custodian you can trust. In our next episode, we'll explore how smart contracts actually work in tokenized ecosystems, and how they automate trust, rules, and rewards. I'm Kora, and this is Tokenization 101. See you in episode 12.